With IUL, you can earn 100% to 500% more than the cost of borrowing rather than withdrawing your money out of that policy. In this educational episode, I'm going to dispel the myth that when using what is called the banking concept, that whole life insurance is superior. No. You need to understand this. It's crucial. So I'm Doug Andrew, and I've been helping thousands of clients now for nearly 5 decades optimize their assets, minimize taxes, empower their authentic wealth, helping many people prepare for a comfortable retirement so they will not outlive their money. The biggest dangers that cause most retirees to outlive their money are taxes, inflation, and market volatility. That's why my favorite financial vehicle is a max-funded indexed universal life insurance contract. Now, I have a lot of critics out there that simply don't know what they don't know. They poo-poo something, and of course, one of my favorite quotes is anonymous. The worst form of ignorance is when you poo-poo something, you reject something that you know very little or nothing about. So when a lot of times insurance agents, whole life agents say, that indexed universal life, that's just an insurance policy where they're investing your cash value into an index mutual fund. No, it isn't. Your money is not in an index mutual fund, or else you would have lost 40% twice in the Great Recession. Our clients didn't lose a dime when the market dropped 40% twice in that decade. We use indexing, that's a strategy. Or they may say, that index universal life is so expensive, it's gonna crash and burn, it's gonna implode because it gets more and more expensive as you get older. I go, no. The cash value, when it's structured correctly, will grow to equal and exceed the death benefit. You'll be self-insured within 12 to 20 years. The insurance costs you nothing. You don't need any guarantees like whole life offers. When your death benefit, you're self-insured now. Because the only thing a guarantee does in whole life is guarantee that the death benefit won't lapse. Well, if your cash value in the 12th year equals or exceeds the original death benefit in indexed universal life, like it is with most of my clients, why do you need a guarantee that the death benefit will not lapse? When you are self-insured, your cash value is the death benefit now. The cost of the insurance is virtually zippo. Okay, you can watch some of my episodes on this. But when we're talking about the banking concept, a lot of times whole life agents say, whole life is superior to index universal life. And I just go, here we go again. They don't know what they don't know. So what is the banking concept? Many times there are people like Nelson Nash, who I know, and he calls it infinite banking. Pamela Yellen, she came out with the term bank on yourself. That's their view of it. But this banking concept has been around for decades. And I was teaching this clear back in the 1970s and 1980s. It's simply how money works. So let's simplify it right now. What does a bank do, or a credit union, or even an insurance company? They borrow OPM, other people's money. So during the decade from 2000 to 2010, interest rates came down, and it was a heyday for banks because they were only paying 1% interest. And so it's because the Federal Reserve interest rates were low. So the banks were having a heyday. Why? Because banks would only pay you 1% interest, but there's only 4 things you can do with your money. You can spend it, you can lend it, you can own with it, or you can give it away. When you put your money in a bank or credit union, or even an insurance company, it's in a lended position. Are they just a benevolent institution paying you interest? No, they're borrowing or paying you interest so they can make more interest. See, sometimes people quip, there's 2 kinds of people in the world, those that pay interest and those that earn interest. And I go, oh, bless your heart. You don't understand how money works. There's a third kind of person, the mega wealthy people that learn when it's wise to pay low interest, turn around and make higher interest. So let me give you an example. Banks, they pay 1%. So on every $1 million of OPM, other people's money, they pay 1% a year on. They're only paying out $10,000 to borrow the public's money. They turn around and they disclosed in 2008 when the country nearly collapsed. And the federal government asked the 5 major banks in America to disclose where they had their tier 1 assets for liquidity and safety. This is money that banks and credit unions have to have on hand, liquid and safe, in case there's a collapse or a run on the bank. Guess where they had it? In insurance companies, in what is called sometimes BOLI, bank-owned life insurance. They own life insurance on other people. They do it for the living benefits. So banks are paying you 1%. They turn around and they don't even link to an index maybe, and they earn 5%. How much more is 5 than 1? Don't say 4. It's 500%. It's 5 times. They are borrowing money and paying $10,000, and they're making $50,000. So they're netting 400% or $40,000. Let me put it this way. Would you hire an employee for $10,000 that made you an extra $50,000? That's called a 500% return on employment cost. Would you buy a widget machine for $10,000 that made you an extra $50,000? That's called a 500% return on equipment cost. Okay, so far so good. So that's what banks were doing. During that same time period when interest rates were low, I was borrowing money, let's say to purchase real estate, and I was borrowing money at 3%. So I can borrow $1 million to acquire a piece of property. And so I borrow and pay 3% interest. That's $30,000 a year. I write off that $30,000 of interest on my tax returns. So it's not costing me $30,000 because I write off $30,000 in a 33% tax bracket. I actually save 1/3, 33% of that $30,000, $10,000. So I get $10,000 back in a refund, or $10,000 in a lower tax bill. And so the net cost of a 3% tax deductible interest on a mortgage, let's say, is 2%. So the net cost of borrowing OPM for me was 2. I was earning on my indexed universal life 11 netting 10. Are you getting it? I'm earning 10% compound interest, tax-free. The net cost is simple interest at 2, just the very first year. I am paying 2 and earning 10. On that $1 million, I'm earning $100,000. It only cost me $20,000 to borrow the $1 million. So I borrowed $1 million, and I was able to earn $100,000, but it only cost me $20,000. I netted $80,000. I'm making 500%. The banks were making 500%. We both understand how money works. It was a heyday. Now, to be honest with you, most of my lifetime, 5 decades, on real estate, for example, I've borrowed at an average rate of maybe 4.5%, some years as high as 6. But if I borrow at 6% tax deductible, it's a net cost of 4. Would you hire an employee for $40,000 that made you an extra $80,000 or $100,000? When I borrow at 4.5% tax deductible in a 33% bracket, it's a net cost of 3. Would you hire an employee for $30,000 on $1 million that made you an extra, $100,000? That is at least a 300% return on employment cost. Are you getting it? That is the banking concept. So whole life insurance is okay. Generally speaking, they tell you accumulate cash value when you go to buy a car or use working capital for business. You can borrow out of your whole life policy, and maybe you might pay 3 or 4% interest. But on the whole life policy, generally speaking, you're only earning maybe 2 or 3 points higher than that. So that's fine. You're hiring an employee for 30 or 40,000, and that employee is making you 60 or 70,000. Yeah, that's still okay. But index universal life, my heavens. I had a client in 2017. He needed to borrow $1 million out of his indexed universal life policy to tie up a piece of real estate with an earnest money. It was a multi-million-dollar apartment complex. And he called me and said, Doug, email me the form. It's one page. He puts his name and his policy number on the form and says, do you want to withdraw $1 million out of your IUL or do you want to borrow? What do you think he checks? Borrow. Well, do you want to borrow at a zero cost loan? That means he borrows at maybe 4%, and they credit him 4% on the $1 million of cash value that's collateralizing the loan from the insurance company. His cash value still stays in the policy. But he chose index loans that year, which is what I normally do. So that's 1% higher. Why would you pay 1% higher? Because they charged him 5% that year, $50,000 on $1 million loan. Now, he doesn't have to write out a check for $50,000. It's like a phantom loan. It's just accruing there on a statement. But now his entire cash value, including the $1 million that's collateral, is earning the indexed rate. Guess what he earned that year on that $1 million that was collateralizing the loan that is being charged 5? He earned 25. It capped out at 25%. He was credited $250,000 on that $1 million. You subtract the $50,000 loan, he netted 20% or $200,000 on his $1 million while he was using the $1 million to make $3 million in his real estate. Hello, that's working capital for business. I've had clients in 2020 to 2021 that borrowed money at 5% out of their IUL, and they got credited 61.33% because they linked that year to a 1 year point to point with no cap. After COVID-19 made the market go down 30%, they linked. 1 year later, they were credited 61.33%. How would you like to borrow money at 5 and earn 61? You show me a whole life policy that even comes close to that. So that's why it's a myth. When you hear that whole life insurance is superior when you're using the banking concept, you better think again because IUL, when structured properly, funded correctly, dwarfs whole life insurance if you're implementing the banking concept. So if you want to learn more about this, we even have a video series that talks about this. But if you want to learn about Indexed Universal Life, I would recommend you study my 11th best-selling book. It's been flying off of our warehouse shelves. It's actually 2 books in one. This side is about 14 chapters, 200 pages, and it gives all the charts and graphs and explanations of how IUL works. That's for the left brain learner. If you're a right brain learner, you flip it over and read this one. Now, I said about 14 chapters. It's exactly 14. I meant about 200 pages. This one is about 100 pages, 12 chapters with 62 actual client stories. If you want to use both your right brain and left brain, I would recommend reading both of these books. You can go to Amazon and purchase it for $20, and if you do, thank you. But I'll gift you one for free. If you want to claim your free copy of this, go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I require some skin in the game. If you buy it on Amazon, you're going to have to pay for shipping and handling, but I'll pay for the book. So that'll save you, the $20. I'll fire out a hard copy to you via priority mail. But when you're in there claiming your free copy, if you like to listen and learn or watch and learn, check out the audio and video formats. Also, if you want to attend an educational webinar, we teach them on a regular basis. They're free. There's no charge. You can even schedule an appointment to talk to an IUL specialist virtually and do it on Zoom or whatever. They will not charge you for their time. There's no cost or obligation. And they'll actually be able to create some illustrations to show you how a properly structured, max-funded IUL works. And if you want to see how the banking concepts works with these various index loans, they'll illustrate that and then compare it to a whole life policy and ask a whole life agent, okay, you show me this whole life policy generating the best income starting at age 60 or 65 out to age 120. What's the best income? And show it using the banking concept. And we'll compare that to an indexed universal life. The whole life policy will not even hold a candle to it. And I would like to prove that to you. So that's a challenge. Check it out, set an appointment, and get some illustrations created for you.